Ever wondered how companies balance dividends and growth? This question is more than just a curiosity, it's a fundamental aspect of investing. When a company earns profit, it has two major options: distribute these earnings as dividends to shareholders, or reinvest in the business for growth. The balance between these two actions can significantly impact the company's long-term success and an investor's return on investment. Consider two companies, Apple and AT&T. Both are titans in their respective industries, yet their approaches to managing dividends and growth provide valuable insights. Apple, a tech juggernaut, is renowned for its modest dividends and significant reinvestment into innovation. On the other hand, AT&T, a telecommunications stalwart, has traditionally favored substantial dividends, but is now shifting gears towards growth. Understanding these strategies is crucial in making informed investment decisions. Now let's dive into how Apple and AT&T approach dividends and growth. Consider Apple, a tech giant known for its balanced approach. This is a company that deftly navigates the delicate dance between rewarding its investors with dividends and retaining a significant chunk of its earnings for continued growth and innovation. Apple's approach is not about making grand gestures with substantial dividends. It's about steady, consistent rewards. A modest dividend payout, yes, but one that is reliable and has seen incremental growth over time. It's a strategy that shows appreciation for the investors who've put their trust in Apple. But it's also a strategy that safeguards the company's future. By retaining a significant portion of its earnings, Apple ensures it has the capital necessary for continued growth. This isn't just about maintaining the status quo, it's about pushing boundaries, disrupting industries, and consistently staying ahead of the curve. It's about investing in research and development, acquiring other technology companies, and expanding their product lines. Apple is not just sitting on its laurels and riding the wave of past successes. They are continuously innovating, continuously expanding, and continuously growing. And this is all possible because of their balanced approach to dividends and earnings retention. The result of this balanced approach is clear: significant appreciation in Apple's stock price over time. This isn't a flash-in-the-pan success story, it's a steady climb, a testament to the power of a balanced approach. And let's not forget the dividends. Despite Apple's focus on growth and innovation, the company has consistently increased its dividend payments to shareholders. It's a nod to the investors, a thank you for their trust, and a tangible return on their investment. This demonstrates how a company can strike a balance between rewarding investors with dividends and funding growth. It's a testament to the power of a measured, thoughtful approach, one that values both the present and the future. It's a strategy that has served Apple well, and one that could serve as a model for other companies looking to balance investor returns with long-term growth prospects. On the other side of the spectrum, we have AT&T, a company that has recently shifted its approach. AT&T has a long-standing history of paying out substantial dividends, thanks to its robust and cash-generating telecommunications business. This generous dividend policy was a pillar of AT&T's strategy, making it a favorite among income-focused investors. However, this approach had its limitations. The high dividend payout ratio left little room for the company to invest in new technologies and market expansion. In a rapidly evolving tech industry, AT&T found itself grappling to keep pace with the changing landscape. It became evident that the company's heavy focus on dividends could potentially hamper its ability to innovate and grow. Recognizing this, AT&T has in recent years re-evaluated its strategy, signaling a significant shift in its capital allocation policy. The new approach aims to reduce its dividend payout ratio, freeing up more capital to be reinvested back into the business. This change in strategy is designed to fuel AT&T's growth initiatives, allowing the company to venture into new markets and invest in emerging technologies. A notable example of this strategic shift is AT&T's acquisition of Warner Media. This move marks AT&T's foray into the media and entertainment industry, a sector far removed from its traditional telecommunications domain. By diversifying into this new arena, AT&T is not only expanding its revenue streams, but also positioning itself to benefit from the growing demand for streaming content in the digital age. This shift in AT&T's strategy underscores the company's recognition of the importance of having a healthy balance between rewarding shareholders with dividends and retaining sufficient capital for growth. It's a bold step that underlines the company's commitment to staying relevant and competitive in an ever-changing industry landscape. In conclusion, AT&T's strategic pivot offers a valuable lesson for both companies and investors. It highlights the need for firms to maintain a delicate balance between delivering immediate shareholder returns through dividends and investing in long-term growth opportunities. This shift illustrates the company's recognition that having ample capital for growth is crucial for long-term success. When comparing Apple and AT&T, the differences in their strategies become apparent. Let's start with Apple. Apple's model is a perfect example of a company that has successfully balanced its dividend distribution while still retaining a significant portion of its earnings for growth and innovation. This strategy has allowed them to continuously reinvest in their business, fueling research and development, and expanding their product lines. As a result, Apple's stock price has appreciated significantly over time, and they've been able to steadily increase their dividend payments to shareholders. However, this strategy does not come without its risks. If Apple's investments in innovation do not yield the expected returns, it could negatively impact their stock price and their ability to sustain or increase dividend payments. Yet, Apple's track record suggests they've been able to manage these risks effectively, making their approach a sound one for long-term success and investor returns. On the other hand, we have AT&T, a company that historically paid a substantial portion of its earnings as dividends. This approach was rooted in the company's stable and cash flow-generating telecommunications business. It allowed AT&T to reward its investors with consistent dividends, creating a sense of reliability and predictability. However, this high dividend payout ratio also had its drawbacks. It limited AT&T's ability to invest in emerging technologies and expand into new markets. Recognizing this, AT&T has recently reevaluated its strategy, aiming to reduce its dividend payout ratio and allocate more capital toward growth initiatives. This shift shows that AT&T has come to understand the importance of having ample capital for growth in ensuring long-term success. But this change in strategy also poses risks. It could potentially disappoint investors who have come to rely on the company's generous dividend payouts. Furthermore, the success of AT&T's growth initiatives is not guaranteed. If these initiatives fail to deliver the expected growth, the company's stock price and dividends could suffer. In conclusion, both Apple and AT&T highlight different paths that companies can take in balancing dividends and growth. Apple's strategy emphasizes a balanced approach, with modest dividends and substantial reinvestment in growth and innovation. AT&T, on the other hand, has historically favored dividends but is now shifting towards a growth-oriented strategy. Both approaches have their potential benefits and risks, and the success of each depends on the company's ability to effectively manage these risks. In the end, the balance between dividends and growth is a crucial factor in a company's long-term success and investor returns. So what can we take away from all this? Well, the path to sustainable growth and investor rewards is often a delicate balancing act. Companies that manage to distribute dividends to their shareholders while also retaining enough earnings for reinvestment can offer some of the best opportunities for long-term investors. Let's glance back at Apple's approach. They've been able to pay out modest dividends, yet still retain a substantial portion of their earnings for reinvestment into growth and innovation. This strategy has allowed them to continually expand their product lines, invest in research and development, and even acquire other technology companies. As a result, Apple has seen significant appreciation in its stock price and has been able to steadily increase its dividend payments to shareholders. On the other hand, we have AT&T, a company that historically paid out a large portion of its earnings as dividends. While this approach provided consistent returns to shareholders, it also limited their ability to invest in emerging technologies and expand into new markets. Recognizing the need for change, AT&T is now looking to reduce its dividend payout ratio and allocate more capital toward growth initiatives. By comparing these two companies, we can see the impact of different dividend policies and capital allocation strategies on a company's growth prospects and investor returns. While high dividend payouts can be attractive in the short term, they can also limit a company's ability to invest in growth opportunities. On the other hand, retaining more earnings for reinvestment can fuel expansion and innovation, potentially leading to higher stock values and sustained dividends in the future. It's clear that a balanced approach, one that rewards investors while also fueling growth, can be a sound long-term strategy. This delicate balance is a testament to the company's strategic vision and its commitment to both its investors and its future. Remember, the best investment strategy is one that aligns with your financial goals and risk tolerance. Always do your due diligence before making investment decisions.